Hi everyone, my name is Jamie Tian and I'm your 2020 AREAA A-List National Chair. Thank you for everyone for joining us today, and I'm super excited to be talking to a panel of our own A-List loan originators from around the country. We'll be chatting today about the outlook of the mortgage industry in 2020, what kind of loan programs are available, interest rates, loan forbearance, how they're adapting to better help their clients in this changing market. So if you have any questions for our panel during this time, please send them our way. And I'm going to go ahead and introduce our panel. First, we have Lysa Catlin from Caliber Loans in Kirkland, Washington. She has over 20 years of experience in the mortgage industry, and Lysa has been recognized by Seattle Magazine as a 5-star mortgage professional, and she's a multi-year winner of the Scotsman's Guide Top 100 Originators, as well as Mortgage Executive's Top 200 Mortgage Originators in America. And she was also named the number 6 top female originator nationwide in 2018 and number 10 in 2019. Fallon has been in the business since age 19 and is currently sales manager at US Bank, based in the Gold Coast of New Jersey. He currently serves as president of the AREAA Northern New Jersey chapter and also the mortgage committee chair for AREAA National. And lastly, we have Shashank Shekhar. He is the CEO of Arcus Lending, based out of San Jose. It's one of the fastest growing mortgage companies in America, with 235 million in personal production last year. He was named the number 14 loan officer and number 4 mortgage broker in the country. He's also a best-selling author and is the creator of MLO Masterclass, which is a training platform for loan officers. So thank you everyone for joining us, and thank you guys for being on our panel today. And I wanted to start with just chatting kind of about overall what's going on in the mortgage industry today and what has changed in the last 2 months since all of this craziness has happened. So what was your business like in March, April, and now, and what has been the evolution? And I'll start with Lysa.
Oh, you're starting with me? Well, happy Friday to everyone. It's a pretty dramatic change. Actually, I was on vacation at the end of February, early March, and kind of came back to a completely new world. The biggest transition for us was we're moving remote and moving our entire workforce remote. We've never worked like that in 20 years. Luckily, we had gone digital a few years ago in terms of our mortgage application, but getting all of our employees home up to speed with internet connection and dual screens was a bit of a challenge, but we've worked through that. And actually, for the most part, we've returned to business as usual, albeit I think we're all working more hours than we've ever worked now that we don't have to commute and take the time to get ready.
How about you guys? How about you, Sean?
Yeah, I mean, kind of what Lysa said. I definitely think we're working more hours, and we're if we're not careful, we're working 24/7, little bits and pieces around the clock, because you can walk down to your home office 5 feet away and jump and finish out a loan. I think though, even for myself, we've gotten a little bit more comfortable with doing some types of marketing and communication with our referral partners and potential referral partners that we weren't maybe in the past, such as these video calls. I've never tried to solicit business over that than I have in the past 30, 45 days. So that's been something new, but it's actually been kind of fun and exciting.
Awesome. And Shashank, can you share as well?
Sure. As in whatever Sean and Lysa said, of course, we live in very, very crazy and unprecedented times right now. I don't think the fundamentals of the business itself have changed. Of course, you need to still provide the same kind of customer service. You still need to be out there for your referral partners. What has changed is probably the tools that we are using. We are using things like Zoom, of course, much more than what we used to do before. We are trying to talk more virtually, and then so there is no in-person interaction. But it also, I think, for the industry, it might not be such a bad thing, because we are trying to get to a world where more people are talking about digitizing the entire process from the time of application to the time of securitization. So it's in a sense that I think the industry will actually come out better and stronger from this. But personally, yeah, I don't think I've ever worked. I've been in the business now for about 12 years. Ever worked harder than the last 8 to 10 weeks, which is, I'm not sure that's a good thing.
That's good. Are you guys seeing a lot more refi business right now, or is it more purchase business? Feel free to jump in.
For me personally, I'm double my purchase business year to date from last year. I think that you know, Seattle's a little bit fortunate locally, even though this has been such a devastating pandemic for so many people. Our workforce does have the ability to work remote. We're pretty high in tech. And so we're actually seeing our local housing market stay pretty strong, especially under $1.5 million. So year to date, I'm actually at 75% purchase. Of course, we're picking up refinances as well. But you know, we're busy.
Yeah. So I wanted to talk about like the changes in the loan program. So I know a lot of the non-QM market has mostly disappeared, and you know a lot of the banks are tightening their restrictions. I heard that Chase is no longer doing you know, investment properties. They're only doing primary residences with 700 credit score, 20% down, things like that. And personally, I even had a client who had a non-QM loan fall out of escrow. So I wanted to talk more about that. What are your guys' thoughts on that? What are your companies still offering and no longer offering? And, you know.
Sure. I think Mortgage Bankers Association comes up with an index called Mortgage Availability Index, which basically tracks how much of mortgage is available right now. And just before the first week of March, we were at the highest level in almost since the Great Recession. So we were at a very stable level where most of the non-QM was doing very well at almost 7-8% of the industry. But just over last 7-8 weeks, it has now dropped to a 5-year low. So the mortgage availability hasn't been worse in the last 5 years, and if anything, it's only going to get worse from here. And we all know that non-QM has mostly disappeared, other than a couple of lenders maybe. The jumbos have disappeared from a lot of non-bank players. Sean works for US Bank, so maybe he will have a different perspective on that. And then even within the normal conforming loans, you have problems like on investment properties or cash out loans. And within the govies like FHA, VA, you have problems with, say, lower credit scores, like if you're under 640. We are a broker, so we of course have access to about 60, 70 different lenders we work with. So from that perspective, we are kind of fortunate, because if one lender does not do something, we can move on to another lender who might have an offer. So we are probably down 10, 15% on that credit availability, not hit that hard. But overall, as I said, the MBA says that the mortgage availability index is down to a 5-year low right now.
And do you guys think that is there going to become non-QM loans available anytime in the near future, do you think? Or what are you seeing, Sean?
Yeah, I mean, I can only speak really from the bank side. You know, I used to be in the broker world, very similar to Shashank. So I remember the flexibilities and some of the fun things that you can do. You know, as far as non-QM, you know, even for some of the larger banks or larger private lenders, even stable niche products like some of the non-warrantable condos, right? Something that's a little bit closer to home in some of the higher end areas like where I'm at in Hoboken. Those have largely disappeared, and that really affected the marketplace a lot, right? Because you have certainly a lot of those around here. You have litigations on these condo buildings that are, you know, 10, 15 years old. As far as non-QM coming back into the space, I think we're going to see it. I think it's going to be a little while, but I think more so than that, I think when non-QM actually does enter back into the space, it's going to look quite a bit different than it did, you know, let's say last year in 2019, because at any time there's some kind of an economic changeover, which we're obviously in a major one, it causes any of these financial institutions, these hedge funds that have created a lot of this non-QM funding, to really kind of inspect what they've lent out, take a look at, you know, where their losses have been, and make those adjustments. So I think non-QM is going to look quite a bit different than what it did previously, that's for sure. But I think we're looking a ways down the road.
Yeah. How about you, Lysa? What kind of changes have you seen in the programs that your company has offered, or just, you know, in the industry in general?
Yeah, to piggyback on what both Sean and Shashank said, we have pulled back on our jumbo programs. Caliber was actually a leader in the non-QM space, and we put that program on hold a couple of months ago. Although we are coming back to market here, so we might again be a leader. I do agree with Sean that I think it will be different, but we are reintroducing several of our jumbo loan programs in the beginning of June. And we're actually still doing 10% down to 2 million. We're still doing loan amounts up to 5 million. One thing that we have seen quite a bit of is With the drop in the prime rate, we're breaking jumbo loans into first and second combinations so that we can do a conforming first mortgage, take advantage of historically low rates, put a second mortgage behind that to get to higher loan amounts. And that's been really successful for us, both from an interest rate standpoint as well as speed. We can still close a conforming loan in 20 days or less.
Now, have you guys seen any changes in the number of new mortgage applications and pre-approvals? Did it slow down and has it picked up again, or has it been pretty steady throughout?
Major increase, big time this year. Obviously some of that is due to the refi boom that we're seeing, obviously, right? But a lot of that also has to do with a combination of obviously historically low rates. I mean, the originators out there, I think, that are doing a good job educating their referral partners and explaining to them that in certain markets, obviously every market's different, but in certain markets they're having, less competition, which is obviously not causing that bump up in certain prices the way we typically see it this time of year. Less competition and then historically low rates. They're probably going to get the best financial deal in some of these markets that they've seen in the past 5 to 7 years, more than likely. And I think, again, obviously us doing a good job of educating our referral partners is really important for that. But we've gotten, like, just on the US bank side, we're getting just slightly over 1,100 applications per day on average now over the past 60 days.
Yeah, that's really positive, I think, for the outlook of the market in general. I think, it's been, obviously the overall economy is kind of, I don't know, no one really knows what's going to happen, but the real estate market seems like is still very optimistic, and the number of applications, mortgage applications, I think is a huge sign that people are still, getting ready to buy and that they want to buy. So
it is. So one of the things, Jamie, is what I wanted to point out is that you're right, as the economy per se, as in at 15% unemployment rate, and of course all the uncertainty around when will this entire COVID-19 situation end. With all of that, the expectation right off the gate was the real estate will be impacted, and it will be impacted soon. But what we are seeing, data after data, as in NAR came up with its March report, I think they're coming up with their April report today. Also more recent reports from Altos Research, and everyone is pointing towards the fact that the inventory continues to stay at the lowest levels that we have seen. And just last week, the median home price touched the high of 2019 back again after going down for 3-4 weeks. So real estate has definitely been bucking the trend and being completely different than what pretty much everyone expected. They thought that we will see several months of slowdown. So in terms of prices, there is of course no slowdown. Number of sales, yes, but also because a lot of sellers are kind of afraid to put the home in the market right now. But there is a definite interest among the buyers. So once we hit the peak of our summer buying season here, I think we will also start seeing the tick on the number of sales as well.
Yeah, some people, I've been reading some analysts saying that possibly we may see the peak of our summer buying season a little bit later this year than usual, because as things start easing up and people start going out again, going back to work. But obviously some cities, New York, LA, are still on lockdown. So, I think maybe hopefully in the later summer, early fall, we might see the peak of our season. So we're hopeful for that. What do you guys think is in store for interest rates for the rest of the year? What kind of rates are you seeing this week? And what do you think is, obviously no one has a crystal ball, but what do you think is in store?
We are quoting under 3% on a 30-year fixed on conforming and govies and pretty much across the board. Not on jumbos. Again, as I said, we don't have too many jumbos right now, especially not at the pricing that probably Sean is getting on some of the jumbos. So I'm envious of you for that, Sean, for sure. But for everything else, this is, we thought that the first week of March was the lowest rate that we would see in a little while. And we thought that the capacity issues and everything with margin calls would take much longer to settle down, but it had settled down in 6 to 8 weeks. Lenders have started pricing much lower again. And so, and pretty much across the board, our pricing on the 30-year fix seems to be at 3% or even under. I just locked a high balance at 2.875 with no closing cost to the borrower. So this is the lowest, of course, we have seen. Fannie Mae came up with a prediction that next year we'll see a 2.9% 30-year fixed rate, but we are seeing that already. So,
Yeah.
so I'm not sure we have to wait until next year to do that.
So do you think it can get even lower? What do you think, Lysa? Can it get lower?
Yeah, I think it's going to move lower, and I think it's going to move lower in the next 30 to 40 days. But I do think you're going to see a lot of volatility. So we expect it to move lower, but maybe not stay long. But you know, if you're bouncing, we're thinking 2.5 right now. We're pretty similar in rate. We're locking most clients between about 2.75 to 3.25, depending on credit score and down payment and closing costs. And we think we're going to see 2.5 here pretty soon.
Yeah, but who knows how long it'll stick around, right?
Exactly.
It might have a couple of hours to lock everything.
And it's so low. Our previous low was November of 2012. You know, at that point, Freddie Mac said we were at 3.32% for the average.
That was the first month in the real estate market.
Really? Well, you had good timing.
Good timing, huh?
Yeah. I mean, the rates are just unbelievably low. And sometimes when I'm giving a client a fee quote, I want to check the math because I think I've made a mistake. So, and of course, that increases affordability.
What did you say the rate was in November 2012?
The average rate was 3.32 per Freddie Mac for a conforming 30-year fix. You know, we're almost a full % lower now than we were this time last year. And that increases a buyer's purchasing power by 10%. It's pretty significant. And when you factor in, at least for what we see here in Seattle, our rents are only going up. We're out of space. We don't have any more room to build. So rents are going higher, and locking now is a great opportunity to inflation-proof your house payment.
Yeah, definitely. So I wanted to talk about a topic, mortgage forbearance. What have you been seeing in terms of that? What is the rate of forbearance? And then if homeowners choose forbearance, will this affect their ability to apply for loans in the future? Maybe I'll start with Sean at US Bank and see what you guys over at the banking side think.
Yeah, it's been interesting. A lot of the battle with forbearance has been fighting, I think, misinformation. I'm sure Shashank and Lysa can attest to that for sure. A lot of time answering the same misinformed poor homeowners again and again. You know, right now we have, I believe it's a little over 4 million folks enrolled in forbearance as of right now, which again represents, I believe, just shy of 8% of the marketplace, which seems very, very small to some folks looking at it, but in reality, the billions of dollars lost are just enormous, and it does greatly affect the marketplace. I think folks need to be aware of that. You know, it definitely is going to affect their ability to obviously refinance. Just, I believe it's yesterday, Fannie Mae came out with a notice that obviously if previously, again, it was obviously if they were enrolled in forbearance, it was going to affect their ability to refinance for about 12 months. Now they've enrolled out a new guideline that as long as they are current and they are registered as current on the actual forbearance payments for 3 consecutive months, that they are eligible for a new loan. And then even if you have somebody who's enrolled in forbearance now who actually has not taken those payments and deferred them, but has actually kept on their payments, and they decided not to take those forbearance, and they can verify that through their credit and through their payoff with their servicer, that they are also eligible. So, you know, to kind of summarize it, these guidelines, again, if we had this webinar 2 weeks ago, that would not have even been mentioned, and we had had a completely different outlook. So it's changing almost week to week, and we could see an adjustment, you know, in another couple weeks or months. So it's just really important for folks to not just take an article that was written, you know, a few weeks ago, but actually talk to whoever their lending partners are and make sure that they're getting up-to-date information.
And do we have data on what percentage of homeowners are choosing forbearance?
Yeah, so we are at 8.8% as of last week. That's across the different loan programs. The Govies, which is your Ginnie Mae, and they are, of course, they're closer to 12%. That's 1 out of 8 borrowers who are choosing forbearance. Fannie Freddie is expectedly lower. They're about at 7%. So one of the things that I want to give a huge shout out to FHFA this time, as I came into the industry in 2008, and I saw that it was kind of, it was death by 1,000 cuts, because we got worse numbers every month. And then before the Fed stepped in at the end of 2008 to lower the rates, and FHFA stepped in terms of HARP loans and everything. It took almost 2 to 3 years to get a grip on what was happening. This time, Federal Housing Federal Administration has been extremely proactive. Like Sean was mentioning, just the forbearance thing. First of all, they came up pretty much in the very first week saying that they will allow almost blanket forbearance. What it does is that it helps you not get into, say, a foreclosure or a short sale. You still get to keep the home if you've lost your job. And then again, last week, they came up with the fact that, hey, even if you are applying for forbearance, because the earlier guideline says that if you're in forbearance, you cannot refinance for 12 months or practically get no mortgages for 12 months. Now they're saying once you come out of it, you can make 3 payments and then you can get yourself refinanced. What all of this is going to do is that all this worry about the fact that 20% people losing jobs will result into a ton of foreclosures and short sales and all of that stuff. FHFA, I think, is being extremely proactive and trying to avoid that down the road. Of course, the situation is very different as well. In 2008, when the crisis hit, pretty much the entire US household had no equity to begin with. We were all maxed out on our LTV. Right now, we are sitting at 53% LTV. So almost half the house is equity across US homeowners. So first of all, we're in a much better situation because everyone has way more equity because we have gained all of that in the last 10 years. And two, all of this proactive stuff of allowing forbearance and then allowing getting a new mortgage, even taking all the missed payments all the way to the end when you can refinance or sell the home. I think all of that are extremely encouraging sign for real estate moving down the road, which will help in terms of the prices remaining stable and not too many foreclosures hitting the market.
I wanted to piggyback on that too, though. I think what Sean said earlier, there's so much misinformation on forbearance. And I think people need to know that there's no free lunch, right? Those payments are still due, and the provisions under the CARES Act only apply to Fannie Mae or Freddie Mac loans or government loans. If you have a portfolio loan or a jumbo loan, it's up to the individual servicer how they choose to report missed payments to the credit report. So those loans we are seeing negative impacts to credit reports if people aren't making their payments. And if you add the payments to the back end of the mortgage and you do a loan modification, it's yet to be seen how that's going to report. But what we saw back in 2008 and 2009, a loan modification had a pretty significant and negative impact to your credit report, and it could change the financing that you would qualify for up to 4 years. So I agree that I think it's important to allow forbearance to support housing and to give people options, but at the same time, it isn't something you want to do unless you really need to do it.
Yeah.
And not to belabor the point, but I think Shashank touched on it. We have right around 50% equity across the country. I mean, that's a staggering amount of equity on average that is usually not the case during a financial crisis. And I think rather than to parlay also with what Lysa said, rather than taking the forbearance, if you don't need to, take 50, 60 grand of cash out on your home and stick that in a kitty because money is just so cheap right now. It's better to do that and to rely on those funds with cheap interest than to blindly click a button of forbearance or click just sign up for some kind of a deferment program, especially through, like Lysa said, a private servicer that may not follow the same rules as the FHFA has done, and they may be dooming themselves and not even realizing it, because human nature is they do the quick and easy thing to fix the problem without really looking into it and making sure that they're going to have their financial life secure once this is all said and it will end at some point, and then everyone's going to be left looking at their checkbooks and figuring out how we're going to do this. I think one of the main hot points is what is in trouble, because again, a lot of good news on Fannie and Freddie. I think one of the things that is actually going to be a little bit of trouble in the next couple of years, and this may be some good news for potential investors, is your multifamily FHA type of loans. I think that is a very interesting market. You have folks, and both these guys can attest to it. You have folks who have qualified with 3.5% down. They have very little to no reserves, and they are depending upon the projected rentability of the other units, the accessory units on that property, in order to even qualify to pay that mortgage payment. And you have folks that across the country are not making rental payments, so therefore that homeowner may not even be able to pay their mortgage, and they have very little reserves to do so. I think that is going to be a little bit of a pocket drop in the market. that we need to keep a close eye on, and that is going to give a lot of investors some opportunity to pick up those loans over the next couple of years.
So I actually have a question that I thought of. With all of these small businesses taking PPP loans and EIDL loans and things like that, will that affect their ability to apply for home loans in the future? Would that affect their debt ratio, or maybe you don't know?
No, it does not. So of course, as of now, PPP loan is considered a loan. So until it's forgiven, or until that grant is given, it will be considered a loan until that point. So it really depends at what point of time do they want to apply for. But the PPP loan is kind of interesting in the overall unemployment environment as well, is because we are talking about the fact that we are at 15% unemployment rate. But a lot of it is artificial, because the PPP is helping some of the small business owners keep their employees, and they only have to keep it for 60 days. So what happens after 60 days is something will be very interesting, because will we see a spike in unemployment rate because after they have gotten their employees paid for 60 days and now they're free to let them go, unless there is another stimulus or another PPP loan that's coming up, then do we see a spike in the unemployment rate even more, maybe over 20%? And by the way, we haven't seen that since Great Depression of 1930s. So, but as of now, PPP will be considered a loan until they have a formal SBA approval that a waiver has been given, or this has been converted to a grant.
Gotcha. So we have a question from the audience. They're saying, comparing with the last financial crisis, which obviously too many people were getting loans now, but considering the unemployment and all of this, do you think that there's a possibility that lenders will loosen their restrictions and allow more people to get loans to kind of stimulate the economy, or are they just going to continue tightening the regulations and just having less and less programs available?
I don't think you're going to see any kind of a loosening of regulations anytime in the near future. The loosening of folks who couldn't qualify for a regular traditional loan, like a Fannie or Freddie based type of loan, were the non-QMs that we were just talking about a few minutes ago. And again, those are all but gone. Even over the past 4 or 5 years after the initial recession, it was very hard to get funding for startup mortgage companies and for other financial institutions. The word mortgage was a 4-letter word when it came to investing, and I think that will happen again. I think that most private lenders and even those who create these non-QM programs, like I referenced before, are going to follow suit and follow very, very closely the rules of Fannie and Freddie, and maybe make some modifications, but I don't think any kind of loosening is coming down the pike anytime soon.
Yeah, I think they have to kind of prevent what happened last time, right? Someone from the audience asked, are refinancing options available if the homeowner is unemployed due to COVID? So how does an underwriter look at that situation? Like, they want to refinance and take advantage of the interest rate, but they're furloughed or partially unemployed.
Yeah, we have a couple of things. If their pay is reduced and they still qualify, then we will proceed with the refinance without an issue. Sometimes we've seen people actually get furloughed and then they get another job right away, which is also fine. If they require their full pay to qualify to refinance, we'll process the loan, we'll approve the loan subject to them being back on the job at regular pay for at least 1 day.
I see. Is that what you guys are pretty much seeing as well?
Yeah, and so technically speaking, if you're unemployed, then of course you do not get a loan. But yeah, you could, as Lysa said, you could be conditionally approved if you know that you're going to go back in 2 weeks or 4 weeks or whatever. And then once it's confirmed that you're back, then that loan can go through. But if that situation continues longer, then of course there's no financing option.
Got it. One of the audience members asked, what programs are available right now for first-time home buyers?
We're still doing down payment assistance. So here locally in Seattle, you can do 0 down as a first-time home buyer if you qualify. There are some income restrictions to that, but we're doing 0% down financing and also doing 3% down with Fannie Mae and Freddie Mac loans, or 3.5% with FHA.
So yeah, all those, as in we are licensed in 14 states, so I get to see the loan options which are available in most of the states. California has pulled out on a couple of down payment programs, but across the nation, most of the, I would say about 70–80% of the options are still there. And of course you have, as an FHA is already at 3.5% down. So that's as low as you can get. There is conventional is still at 3% down. So those options are already available to first-time home buyers. And then in some cases, they might qualify depending on where they are, in which county and which state they are in the country. If they're still offering down payment assistance, that can go on top of it.
I gotcha. What's going on with like appraisals? Are the appraisers going inside the homes? Are they doing drive-by appraisals? Are the appraisals still coming in? Any trends on that?
That is like the only good part of COVID, I feel like. The appraisal process has gotten so much easier. We're doing drive-by appraisals even on jumbos. We're getting appraisal waivers fairly regularly, or even desktop appraisals where the appraiser can do everything from their desktop without having to view the home. In the cases where an interior inspection is required, we're seeing appraisers requesting that the homeowner turn on all the lights and leave all the doors open so that they can go into the home safely without having to touch any surfaces. But I feel like the appraisal process has actually gotten quite a bit easier than it was prior to the pandemic.
Yeah, definitely more flexibility, 100%. Like we at US Bank, we partner with a company called Red Sky that actually US Bank is an owner of, and so that's our management company. So it's all kind of under one roof a little bit, which is nice. And what they'll allow, same thing like Lisa said, right? Even on jumbos on our portfolio and the refinances we're doing, we're being pretty flexible with appraisal waivers. But then also on top of that, we're also leave it up to the appraiser themselves. If an appraiser goes out there and can get data and says, no, I can just do a drive-by, I don't need to go into the home. If the appraiser deems that the case, which many times obviously for their own safety, and now that they can get a lot of this data online, especially if the property was recently purchased in the past few years, they absolutely really don't need to go into the home. So a lot more flexibility, and it's become a lot more fluid and more of a case-by-case communicative type of process rather than a strict yes or no.
Got it.
So the adaptability and the resilience of this industry over the last few weeks, it's something that I guess we should all be really proud of. And when the entire country is struggling and most of the businesses are shut down, when this happened in the first week, that was my first reaction, because my title company came back saying, hey, the counties are closed, we can't record. The AMC came back saying, sorry, we can't do appraisals because we are in the San Francisco Bay Area, which was one of the first counties in the country to go into lockdown. So you get all of this news within 48 hours saying, which basically meant that we had our biggest pipeline setting, and I was like, okay, we are not going to close any of this stuff. So what's the point? But FHFA came up with its own guideline. AMC's kind of, they adapted to the situation, like Lisa was saying, as we have had borrowers where they could take pictures from the window because they said there are multiple windows in the house. They can take it from outside. They don't even need to go in. Of course, we are getting a ton of property inspection waivers, especially on refinances where the LTV is low. And the appraisers themselves, I think they have been extremely smart in understanding that they are not going to plan for the future by themselves, not knowing where it is. So they were still taking the right comparables in terms of coming up with value. So I don't even remember even one purchase transaction where we actually had a lower value just because somebody was projecting where the future home value would be. So very, very impressed with with of course the overall adaptability of the industry, but definitely appraisal has been one of the high points during this crisis.
I agree. Yeah, and they've been able to adapt very quickly, which has been impressive, like you said. Audience member asks, are there any forecasts for like potential foreclosure rates in the near future now that we see like these forbearance rates?
I don't think you're going to see a wave of foreclosures, and I think it goes back to what we've all touched upon, and is the amount of equity that people are sitting on in their homes. They could certainly turn around and sell it. Inventory is incredibly low, and there is pretty strong pent-up buyer demand. So they can sell, or they can work with their mortgage servicers to modify the loan or work out a payment plan. So I don't think you're going to see a massive wave of foreclosures or short sales. I would be really surprised if we did.
Do you guys agree, Sean?
Yeah, no, I agree. I think for the vast majority, what Lysa said is 100% accurate. I said, I think we're only going to see pockets of fallout in the market. It's not going to be. I stay very far away from the word crash because it's just not even comparable to what it was. It's a completely different animal right now. But I think if anything, it's going to be those low percent down multifamily type of homes on those first time FHAs. I think we will see a lot of negative activity on that. But I think conversely, on the other side of the coin, it's going to be an incredible opportunity for a lot of sell-offs, just like Lysa said. So I think it's going to be almost black and white on either end of those. I think it'll be pretty rough in certain areas, some very high-end areas, expensive areas on those multifamily FHAs, but then it'll be great for a lot of the other homeowners, especially those who are with Fannie and Freddie.
Yeah. And personally, I do think we're going to see a little bit of disparity in different income level neighborhoods, right? So certain neighborhoods are obviously having more job loss and more unemployment. And I think we may see more of those things happening in those type of neighborhoods and less so in, the higher income areas. Audience member asked, I'm getting ready to take the SAFE MLS exam. Do you think this is a good time to get into the loan business?
I got in the business in 2008. So, and so far I've been able to brag that I got in the worst time that I could. Hope 2020 doesn't change that for me. But yes, absolutely. As you shouldn't be looking when you're getting in a business like mortgages, as in this is not a 6 month or a year, as in hopefully you're trying to get into it as a career. You're trying to stay in this for several years, maybe even several decades. If that's the case, then any time is a good time, because even in our worst of years, we have done almost $1 trillion in origination. As mortgage business in the US is one of the biggest industry in the world, even during our worst years, like say 2008, 2009. So given that, it presents itself with huge opportunity. We talked about the interest rate prediction and the fact that we might see low interest rates last for several months from where we are right now. If given all of that stuff, there's no reason why you should not get into business now. Of course, you have to work your ass off. This is a very, very difficult business to be in, irrespective of when you get in, whether it's 2008 or 2020 or even say better years. So that's something you should be prepared for. As that's one advice, because I got in when I was 1.5 years in the country. I knew no one, literally 3 people in the entire country, and I started in 2008. So I can tell you firsthand that it's not an easy business to be in, irrespective of which time you come in. But yeah, if you're willing to do the work, it could be one of the most rewarding industry you could be part of.
So since a lot of our audience members are loan originators and realtors, and what would one piece of advice from each of you would you give to a brand new loan agent? If you could look back now at when you first started, like something that you learned that you wish you knew.
I'll take that one. I think keep it simple. I think that especially now you're seeing a shift back to the basics, answering your phone, being informed, getting back to your clients, and really getting in front of people as much as you can, whether it's by Zoom or all these new apps that we're getting familiar with. But I've been in the industry a long time. I'm second generation, and it feels like that over the last 5 to 7 years, there's been all these coaching groups, and you need to make so many calls on Monday, and just lots of different fancy bells and whistles. And I really think you're seeing a shift back to the basics, someone that you can trust, who's well informed, and who can guide you through the process. So my advice is keep it simple, work hard, and do a good job.
Yeah, the human touch, right? The personal connection is more important than ever now. How about you, Sean?
I love what Lysa said. Keeping it simple, 100% right now. I think everyone's all zoomed out, right? We're sick and tired of staring at people's screens. So sometimes, I see people in my neighborhood, they're in little circles on the street. I mean, it's funny to watch, right? But we want some kind of human interaction, and we want to buckle down with the people who, like Lysa said, we really do know, like, love, and trust. And we have a history with them of doing business. I think I would say find somebody who you can lean on and learn from. who's been through another crash, who went through 2008, who's gone through a few things, who understands what to do during this time and is still doing well, hasn't crashed and burned since then. And then, stay in front of your referral partners and I mean, the people who really are making your business work. During a time, especially in a refi boom, loan officers can get very distracted with an exciting bunch of refis coming in and can forget about the really referral partners that are actually going to make their business roll in the long haul once this refi boom is over. And again, this could last for quite some time, which is great, but you need to make sure that you're putting in some kind of infrastructure into your business to constantly keep in front of those referral partners, because if you don't, technology is very fast nowadays, and there are many, many other loan originators who can get in front of those referral partners and start capturing that business if you're too busy and staying away from them. So keeping yourself in front of them, even if it's just to have a little, whatever, a phone call at night or a little one-on-one Zoom and have your little get together with them, any way you can keep in touch with them and just let them know you're there is really, really important right now, more than ever.
Yeah, I totally agree. How about you, Shashank? Do you have one piece of advice for a new loan officer?
Sure, and great advice both from Lysa and Sean. I think it's very important that we stay focused and we are learning all the time. It's a very there's a lot to learn in this industry. And even after 12 years, there is always something new that I find out pretty much every week. Oh, I didn't know about this kind of a thing. So and if you're starting out, try to learn all aspects of the business. I pride myself with the fact that I probably know underwriting guidelines cover to cover. I know how to do processing of a loan. I even know how to fund. Like, I understand, even though I don't have to do it, I understand all the aspects, because when you do that, then you're more informed, you're more realistic when you're trying to communicate what kind of expectations people might have. Because I see, because we have a lot of loan officers across the country, and some of them will be like, they send the conditions and they're promising the real estate agents that docs will be out in the escrow tomorrow or whatever. That's not how it works. And there's a process with which it has to go, and then something happens. So I would say the first thing that you really need to focus on is that learn a lot. That's very important, and figure out how to get business. With everything else there is, as in all the shiny bells and whistles and tools and strategies and coaching programs, the most important thing is, can you get clients? And then so work on your strength and figure out at least one way in which you can get your first 5 or 10 clients.
That's all really good advice. Somebody asked, is it possible to do real estate and loans at the same time? And if so, how? I mean, yeah, I guess technically it is possible. I have met people who have been able to do both, although I think to do both very successfully would be probably pretty difficult. I don't know if you guys have any thoughts on that.
I can't imagine doing both. I mean, I think a huge part of what we all do as mortgage originators is watch the market, things are changing sometimes once or twice, even 3 times a day. And same with real estate. I can't imagine that you could stay up and be well informed enough on both to do both really well. And I think what was said earlier is you have to work hard. You have to know what you're doing. So personally, for me, I think that would be very difficult to do both well.
Yeah, you got to master something. You have to master something, right? And like Shashank said, right, it's going to take some time to learn the guidelines. It's going to, I mean, my goodness, we're relearning guidelines all over again, right? Over the past couple months, and we're trying to educate folks who have no idea what's going on. You've got to really master something. You don't want to be okay at both just to try. And usually, not always, but the motivating factor behind doing both is I want to make money off all sides of every transaction I possibly can. But, we're only as good as the time we have. We all have 24 hours in a day. And I think it's better suited focusing that time on being great at one or the other.
Got it. So I'll chime in a little bit too. I think that it's just like spreading yourself too thin, right? You only have so many hours in a day, and if you're doing too many things at once, I don't think you'll be able to do it successfully. And also, I think there might be kind of like a trust factor issue there too, in that like if you're covering all the bases yourself, your client will have to really trust you, and there's kind of like ethical boundaries there, sort of. So, yeah. What do you guys think? What are you guys doing now to, educate yourselves and better be able to help your customers now in the rest of 2020?
I've gotten to probably more learning than ever before. I have always followed at least the 5-hour rule, which Bill Gates or Jack Ma or pretty much most of successful people do, which is you need to invest at least an hour a day into learning, into growing yourself. But I realized that once the crisis hit, that there were a ton of things that I did not personally understand. There were things around margin calls, and there were things about servicing advances. Like there are tons of technical stuff that I wasn't too sure about. And I pride myself into providing education. I started blogging in 2009 when only 10 people in the entire industry were blogging. And then since then, I've written over 1,000 blog posts and featured on some of the biggest media in the world. But really, I personally realized that I wasn't very comfortable about some of these stuff, talking about it in public. So I started looking at who are the experts in this field, what are the kind of publications I could be reading, and I tried to get back to that and understand more, and went to a point where now I'm confident talking about those stuff. And I think that's very important for everyone, irrespective of how many years you have been in the business, is that you are constantly learning. Because if you're not growing, whether you're learning about sales tips or learning about just the industry itself or different terms or how to work with referral partners, whatever you are working with, but you need to be constantly learning. And that learning, what you are learning could be different depending on what stage of the career you're in or what kind of environment you are in. But that's something you should never stop doing. And that's the difference that you will see in probably the top 200 on Scotsman Guide or top 1% on Wall Street Journal real estate agents, is that when you meet with them, you will find out that they are always learning, irrespective of whether they are 50 million or 200 million producer. They never think that they know everything there is to learn.
One of the audience members asked, can you do loans in other states? So I know you mentioned you do loans in 14 states. How does that work? You have to get licensed in each state and learn the different regulations in each state. Does it vary a lot, or?
It does. And Sean works for a bank. He might even be doing all 50 states. He can chime in on that, because as a loan officer for a federal bank, usually you have that kind of an option. But for us, we do need to get tested and licensed in every individual state. And their guidelines could be different. The mortgage guidelines kind of stays the same across the country. What really changes is what's different on the real estate side. And that I have found out several times when I was doing my first loan in Washington, for example, or a lot of attorney estates like New York, and we are doing a lot of loans now in North Carolina and New York and all those states. And only realized it, like, we were asking for fees from escrow company, and they were saying, what escrow company? We don't have escrow company. So you find out about all these new things when you go into new estates. So it's not that easy. As in the mortgages per se, the guidelines remain the same overall, but how the process works and who are the different parties in a transaction could vary significantly between different states.
Yeah. To chime in with Shashank there, because I came from private lending just like where he's at, and you do have to get licensed in each individual state. At one point, I held 18 licenses, so my continuing education started in like June to the end of the year. It was just crazy.
Or Jan.
Oh my gosh. So, I mean, now, thank God I don't do that anymore. It's great. And there's trade-offs to every kind of model that you have. I would say, though, to anyone who's looking to get licensed in multiple states, make sure you understand, like Shashank said it perfectly, understand the real estate guidelines of that state to make sure it fits with your business model and the products you have. Don't just get licensed because it's right next door. Don't just get licensed because you have one buddy there who, just got his real estate license a month ago. Make sure that you have some kind of a base to work with, and that the product line that you have matches the needs of that state, so that you actually know you can extract good, sustainable, repeat business again and again if you're going to go down that road.
What are some of the differences, I guess, in working for a big bank versus, being a private lender? And do you think that one is better than the other for a new loan officer? You might be biased. You can't answer the question.
Yeah, I've always believed that every channel has its own space, and it's really depends on what your goals are and what is it that you're trying to do. For example, a big bank can have fixed salary, and you might be a little bit more comfortable with the fact that, hey, on day one, I'm making some money, even though if I'm not originating something. Having said that, I don't know how many big banks will hire someone who is brand new and day one in the job. but that could be something which might be motivating for you, or something that you might work. As in, for some people, having the range of products which maybe say a bigger bank does not have, that might be more appealing for you, because you might be working with, say, non-QM clients, for example, and a big bank may not offer that. So really, I would I wouldn't ever say that there is one which is better than the other. It might be, one might be better than the other for you as a loan officer. One might be better than the other for a certain consumer because of their needs. But overall, you need to study all the different channels there are, whether it's a brokerage model or a direct lending model or a big bank. And thankfully, all three of us are kind of representing three different channels today, and we can talk about it. But yeah, that's something that you as a loan officer should study, should figure out, because when we recruit, we look at the same thing, is that, hey, you are coming from retail world or a big bank world. What is it that you're used to, and can we provide that or not? In some cases, yes, we can. We can even do better than what they have. But in some cases, we can't even match some of the services or some of the benefits that they might have with the other lenders.
So
Yeah,
go ahead.
Go ahead.
No,
I was just going to say, because I came from, the private banking world, and I swore up and down I would never, ever go to a big bank, but I think the product for your area makes your decision for you, right?
Yes.
I'm in a very high-end area, so jumbo, high balance, and upwards is really most of the marketplace, and that's where a lot of the activity is given. So I was with private lending for my entire career up until this point, and we just could not compete any longer on price point, on rate, right? So Shashank and Lysa alluded to this earlier, right? Depending upon the lender and the bank that you're with, they have certain products that they're just great at, right? That they just have an appetite for. For us at US Bank, one of them is jumbos, right? We haven't skipped a beat on jumbos. Matter of fact, on the jumbo space, other loan officers are my best referral source right now. So they're great right now. I love spending time with loan officers, but you got to make sure that the market share that you're going after in the area that you're in actually fits for the products that you need. And if the company you're with does not have those products, you're always going to be behind the 8 ball. And that's not just thinking the grass is greener over the other side, but you need to have inspect what you expect and have a practical look at what kind of products you need to make a splash.
Yeah, that makes sense. I was curious, what have you guys been seeing in terms of foreign investors? Are there still foreign investor programs? Are we seeing any activity in terms of that, or have the foreign investors backed off?
We still do foreign national loans, but I do think that they are backing down just a little bit. One thing that we deal with locally is we have a workforce that's coming from all over the world, and oftentimes their down payment funds are overseas. Some of the countries have made it more difficult to take money out of that individual country and bring it to the US. So we have seen either less down payment or longer timelines to give people time to move their money into the US prior to closing.
And what kind of foreign investor programs do you have? Like,
we will do 40% down payment for a foreign national.
Gotcha.
So, Jamie, we are the preferred lender for one of the biggest condo projects in downtown LA, and that brings a lot of foreign interest into it, just because of the location and the price point and everything. And so we do have a bank to place those foreign investor program. Also, as Lysa was saying, she is in Seattle, I'm in Silicon Valley, and we see both of us a ton of immigrant population here on work visas. Probably 30% of my business, maybe even 40% of my business is that clientele, first-time home buyers who are buying home here and who are immigrants. And we have seen some challenges because we have buyers from China and India and South America and Europe, and in most countries they have some kind of restrictions right now not to get the funds out. Of course, every country is worried about they want to keep the funds to themselves as much as they can. So we have seen a little bit of slowdown in terms of gifts. So we have to be creative around whether you do a 10% down, do a piggyback loans, and try to do a lower down payment options. But yeah, but foreign national program is still there. And of course, it's 40% down. I think it's across 40 or 35% down across the board.
But are you guys seeing people still taking advantage of it now that people can't travel and, you know, all this is going on? Or, I mean, I haven't seen as many foreign buyers in the market. Have you guys seen a slowdown
We're
in that?
seeing sellers really hesitant to accept foreign
Ah,
funds. So
yeah.
that's where I think, at least locally for us, that sellers are, you know, we're seeing multiple offers on a well-priced property under $1.5 million. The high end, I think, is a different story, but up to about $1.5 million. I mean, I had several offers this weekend go out where there was upwards of 10 offers on one home. So I think really you're seeing the sellers here locally being hesitant over the
Risk falling out of
restrictions.
escrow, yeah.
Yeah.
Makes sense. Sean, do you have anything to chime in terms of the foreign programs?
Not a whole lot, to be honest with you. I mean, we see a lot of foreign buyers, obviously, in the New York metro area. A lot of them, though, are not, you know, first-time immigrant buyers. A lot of them are money being shipped over from mom and dad in Korea or China, or their college students who maybe has a job and they're buying him a nice little, you know, $1 million condo as a you know, coming to America gift or something like that. But those are always usually under traditional kind of guidelines and loans. So we don't really do any foreign national kind of stuff. We stick to the jumbo market and portfolio loans there, but we do see a steady stream of them still coming in.
That's a good question. Somebody asked from the audience, is the lowest rate always the #1 focus for choosing a loan?
No, speed for us locally. Sometimes it's how quickly can you close.
Yep. Reputation too, you know, having you know, the realtors and the other referral partners who you have a reputation with. You know, you may have, we all can testify to this, some online lender from across the country comes in and offers them an 1/8 lower, right? And but again, is that seller really going to rely on some, you know, lender that they've never heard from, they don't have any kind of relationship whatsoever, or maybe an 1/8 higher, but like Lysa said, speed and reputation of service, knowing that we can actually get to the closing table, especially right now with so many shakeups in guidelines. Your reputation and your relationships in your local marketplace are huge.
Yeah.
100%
No, I totally
agree.
agree as well. I think, you know, even as realtors, when we refer our lender partners over to our clients, that's what we're looking for. Is obviously we want to make sure they have the best rates, but also different lenders have different programs, as we've talked about, that fit different types of clients. And then obviously customer service and speed is really important too, because a lot of the times, you know, during the escrow, everything's going great, and then it's always like, you know, the lender that's holding it up at the end, we can't close, and then everyone's angry at the realtor, and, you know, we're all scrambling around trying to hold off on the contingencies and hold off on the notice to performs and everything like that. So when we have a trusted lender that is quick and has proven to us that they're fast, that's someone that we're going to refer to our, you know, our clients.
No, it totally makes sense because first of all, you don't even know what's the lowest rate, and you haven't checked every single lender in the country. And so I tell people is that, hey, if you try enough, you will find a lender which is cheaper than us. It might take you some time, but you'll be able to do that. Again, I live in the most expensive county in the country, in Santa Clara County, with a median price of $1.4 million. And so if it was just the rate, as in forget 235 million last year, I wouldn't have probably even done 23 million. People like Sean with working for US Bank could discount me with like 0.5% on jumbo rates, maybe even more. As in there have been times where we have quoted 3.25 and somebody got 2.25 or whatever. So if that was the only reason why people worked with a lender, then of course, as in people like us would probably not be in the business. What they are going after and what they should be going after is, of course, the customer service and the speed, and even more importantly, the expertise. And are they recommending you the right loan program? Are they understanding what your goal is? Can they work through your unique situation? As in all of that is as much important, because if all that you're looking at is the lowest rate on Bankrate or Zillow, wherever it is, then you will run into some serious problems. And we see that documented every single day, both within the real estate agent community and within the mortgage community. And so that shouldn't be your top choice for sure.
And when you're shopping rates, you want to make sure you get a loan commitment letter, right? Because you want to look at all the terms and make sure it's actually apples to apples, because, you know, all the terms can make a difference.
100%. I had a a client yesterday. They're purchasing a home down in Florida, and they got offered, obviously a very, very large concession from the builder. But then after looking at a loan estimate, right, I said, let's compare apples to apples, right? There's an extra $5,200 in fees on it, right? So it's not always what it seems to be. And I think, it's just all about us, not getting, I think this happens with a lot of newer loan originators. They just get flustered. They'd just rather have the quick answer. Oh, come on, let me match that rate, rather than taking the time to really investigate and properly educate the client and show them what real numbers are looking like.
Yeah, that's a great learning. If you are a loan officer and someone comes to you saying, yeah, I'm getting a much lower rate, the first thing you should be asking for, hey, do you have a loan estimate that I can look at? Because as in sometimes you might genuinely not have that rate, and which is fine, and that's totally okay. But a lot of times, as in all they hear is that, hey, I got 2.75 from someone else. They're not looking at how much of origination fees there might be. They might not be looking at the fact that they're only committing to, say, a 15-day rate lock when their contract could be 45 or 60 days long, and they might end up paying lock extension on that. They might not be looking at the fact that those two are maybe completely different loan programs. They might be comparing a 30-year fixed with a 7-year arm. So as a loan officer, you should always see if you can get a loan estimate that you can compare. With builders, it happens all the time, because they're like, hey, if you work with my preferred lender, you get $8,000 in extra incentives or whatever. And then we see that, oh, the rates are 0.25% higher, or they have an extra origination point, which we might not have at our end. So that's a very important learning, that you don't try to just get back and try to match the rate and discount your own revenue and commission on the loan, but actually study the loan estimate. And that's actually a great education for the buyer itself, because they will trust you more now that you do an apple-to-apple comparison and see this guy was technically cheating you in the sense that he was only giving you part of the information, but here is the fair comparison between the two. And they might end up working with you even if it's a small delta between the two options.
Yep, 100%. Good advice. All right, so it's 11 o'clock. We're going to wrap up. I'm going to wrap up by allowing each of you guys to remind us what areas you work in and the best way to contact you. So I'll start with you, Lysa. Oh,
okay. I'm Lysa Catlin. I'm with Caliber Home Loans in Kirkland, Washington. And best way to contact me is by text or call at 206-963-0191.
All right, and Sean?
Sean Phalon with US Bank, based in Hoboken, New Jersey, basically right across the river from New York. Same way to contact me is best by cell phone, calling or text, 862-354-1837.
All right, and Shashank?
I am Shashank Shekhar. I'm in San Jose, California, and all my contact details are on my blog, which is mortgageblog.com.
Oh, that's easy. Perfect. All right, well, thank you so much for our panelists for being part of our panel today. And thank you so much for the audience for joining us. And I hope everyone has a wonderful Memorial Day weekend.
You too. Thanks so much.
Thanks, Jamie.
Thanks, bye.